Welcome to Barenaked Money, the podcast where we strip down the complex world of finance to its bare essentials. With your hosts, Josh Sheluk and Colin White, portfolio managers with Verecan Capital Management, Inc.
Welcome to the next episode of Barenaked Money. The OG, Josh and Colin, coming at you with an amalgam of the most frequently asked questions, at least in the opinion of, I don't know whose opinion this is, the opinion of the team, Catherine's opinion, or who correlated this list of frequently asked questions? How do we keep track of this?
Well, someone thought they were frequently asked, so they must exist in more than one form somewhere out there. So we thought, well, we should probably answer them. And I think a lot of these questions we've probably answered in some way at various points on this pod, but it doesn't hurt to answer them again in a more direct form.
Let us Sabbath at the heart of the demon and try to provide answers that will satiate our audience. Yeah. You have the list as always, Josh. You're in control.
I do, and we're going to be all over the place. So please don't write us a follow-up or a feedback email saying that you guys were all over the place. We know that's by design.
It's a feature. It's not a bug.
Exactly. The first question here is, this is as old as time, I think. Why do you own mutual funds? What's the point of a mutual fund? Are they not super expensive?
Well, it's funny because that question was mainly asked by people who were trying to sell you something that wasn't a mutual fund. Am I wrong? Are those the people most frequently asking the question?
Maybe, but I think this question has made its way into the mainstream media over the past, 5 to 10 years, I think is probably a fair comment. So I don't think that they're trying to sell us a different product necessarily. They're media services, but not a different investment product, I don't think.
Yeah, well, you're right. We deal with this all the time. And the funny thing is, the interesting thing is I'm agnostic. Like I don't think that they're either good nor evil, but they can serve a purpose. And, we are style agnostic. We are product agnostic in our approach. So we do use them, and I've used them my whole career, but for very specific things. Now, you're absolutely right. The vast majority of mutual funds, I will give it to all of the critics, the vast majority of mutual funds are overpriced for what they deliver. They are manufactured to meet a demand, and that demand is people are willing to buy them. They're not demanding them to be good, they're demanding them to be, sellable. So the whole industry panders to whatever the most recent demand might be, whatever they can sell. So yeah, I don't know what we're up to, Josh. We must be over 30. Last I was aware, it was over 25. It must be over 30,000 mutual fund offerings in Canada alone. And yes, I would agree as an industry, the vast majority just is not worth the price you end up paying for it, for sure. But hey, as the amazing chief investment officer of a national wealth management firm, Josh, why do we actually use them from time to time?
Well, it's important to, I think, just answer the question directly. Why do you own mutual funds? Because we think that they can add value and be a wealth growing, productive component of client portfolios over time. And I think that this question exists in the form it does today because supposedly or seemingly cheaper or better or whatever, more efficient option is available in the form of an ETF, an exchange traded fund. Yep. And I was trying to think of the right analogy for this. And for me, it comes a lot to like ETFs are kind of the EVs, the electric vehicles. Yeah. Both internal combustion engine and EVs, they're going to get you from point A to point B. They're both going to have four wheels. Tires are going to be made of rubber. They're going to have brakes. They're going to have an engine. They get you there in a slightly different format, right? One uses gasoline. The other one uses electric power. And some people are going to have a preference for one over the other. Some cases, one situation is going to be better than the next. Like if I'm driving across Canada, I'm pretty sure I still want an internal combustion engine. If I live in the Arctic, I'm pretty sure I don't want an EV. But if my longest drive is 10 kilometers to the grocery store and I live in a place that's abundant in electricity and warm and sunny all the time, then maybe an EV is an awesome option, right? And that's the way that we approach this stuff is what am I trying to do? And what's going to be the right format for me to do it in? This whole thing about mutual funds expensive and ETFs cheap. It's not really that's not really the point. The point is that active management, which is traditionally more associated with mutual funds, costs more than passive management, which is traditionally more associated with ETFs. So that we just need to reframe the question a little bit, because there are some god awful, horribly overpriced ETFs that are out there that are probably a lot more damaging than a lot of the mutual funds that are out there, quite frankly. And at the end of the day, these are just both vehicles that allow you to buy a basket of investments, whether that's Japanese stocks or Canadian government bonds or whatever it is. You can do it in either vehicle. The nuances are slightly different, but they're very nuanced, the differences between one or the other.
I've always pointed out that it's, the conversation about price, if that's all you have to talk about, that's what you talk about. But when we're evaluating something, it's always on the net performance. Like if we're going to evaluate a mutual fund, it's what is the net return after all fees? That's what gets compared. That's what gets analyzed. So again, you can charge me 10% a year, but if you're giving me a better rate of return in a given area of either geography or market cap space or something, if you're legitimately, adding value amongst all of the competitors, well, I would be stupid to exclude you just because you were the most expensive. Now, having said that, there is a correlation between being overpriced and to negative performance for sure. Yeah. But I think at the end of the day, it's about, after all fees are considered, where is the best way? The other thing I would say is that, using mutual funds and some of the larger investment houses, it gets us access to markets we wouldn't otherwise have, access to. And, they've got boots on the ground in other parts of the world where, we have deemed that to be valuable, we wanted to take advantage of. And I think in the mutual fund space, I don't know if we wanted to get into product here, but, PIMCO is one of the ones that you see quite often used in the fixed income space because they have unparalleled global reach. And that's not something that's replicable. Again, taking a look at the performances as we evaluate them, yeah, it makes sense to have somebody there that it's something we cannot replicate other ways. So, anybody who's trying to simplify the conversation to cheaper is better, mutual funds evil, they're not having a full conversation. They're not considering all the nuances that are important in this. And we're not trying to sell you a mutual fund. We're completely, if somebody walked in tomorrow and wanted to replace one of our mutual funds with a truly better option, we're not going to make any more or less money, and we're not married to any of our ideas. So, but without any restrictions, this is where we've landed, using some mutual funds from time to time.
All right. So moving on, this is one that I think is near and dear to your heart. What are these zero fee companies all about, and how do they make money? So I think this is more specifically referring to the zero commission trading platforms and things like, hey, you can trade for free here. What are they all about? How do they make their money?
If we want to get our average back down to 2 minutes, I'll just say they sell your order flow.
It's a good start.
Do you want me to keep going? No, if you're not paying to be there, you're the product. So that's always been true. And I think that's credited back to somebody in the 70s, 60s or 70s, I forget the guy's name. But it's absolutely true. So those institutions are making money off of order flow. So when you place an order with them, they sell that order, most cases, to a hedge fund that executes it. And that execution, they shave a few pennies off using different mechanisms. Also, they make money off of the, holding cash. Every time cash gets deposited to account, sits there for a day or two, they get to pocket the cash. So when you have a large institution that is, has economies of scale, it's very reasonable they could offer that. Now, you're not getting the best execution you could get, and, you're not the client. So, they're not going to necessarily treat you as a client. And there's been examples of that where the trading platform behaved in its own best interest. And everybody jumped up and down and said, we're your clients. Well, no, you're not. You didn't pay to be there. You're the product. It's like being the cow.
I want my money back.
Going, I object to being milked. Yeah. That's why you're here. You're here to be milked. Like, you can't be upset about that.
Yeah. So
I don't know. Did I give them enough flavor, Josh?
Well, yeah, no, that's good. I mean, I think there's a couple other things that they make money off. Even though they're charging you zero, perhaps, for the actual stock trade execution, there are other costs that could be involved. Foreign exchange is something that they make a lot of money on. So if you're a
Yes,
Canadian buying US stocks or US options, that's a big money maker for them. There's also the fact that options exist, and now cryptocurrencies exist on a lot of these platforms. So there's more meaningful commission charges for executing trades in some of those other areas where it's I guess free stock trading is kind of like a gateway drug. You start with
Well,
free stock trading and you end up trading, penny options on Google for 3 years out.
this is just like Fortnite's business model. Like, we're giving away to free to a whole bunch of people. I want you in. Well, do you want this fancy skin? Would you like this interesting gun? Like, for another $5, we're going to give you. So it's the gamification of investing, right?
Yeah.
We're going to let you into the base game for free. If you want to do anything fancy, like all the other cool kids, it's going to cost you $5 or $20 or what have you. So
Yeah. Yeah. But the bottom line is there's several ways that they make money off of you, and all of them, almost all of them, I would say, are tied to how much trading activity that you're doing. And so they're incentivized, the business is incentivized to make you trade more. And by the way, there's repeatedly proven negative correlation between the amount of trading that you do and the returns that you actually realize. So the more trading that you do, the more detrimental it is to your long-term results on
we're
average.
going to generously provide you with a video training series of 20-minute videos and teaching you exactly how to aggressively trade and how much money you can make aggressively trading. And they're going to give you a certificate. Like, your account's going to get a little star in the corner because you've completed 8 hours of training. Therefore, you must be a certified trader. Anyway, I'm sorry, that's a hyperbole and exaggeration to make a point, but that's how those platforms are going to reel you in over time.
Yeah. So next question here, what are some of the questions I should ask my current advisor or my non-Verecan advisor or even my Verecan advisor to get a good sense of whether they're good or not?
That's like interviewing for a job. Like, you can ask all the questions in your world, but it's difficult to figure out who's good and who's not. But again, we've pointed this out in previous pods. Looking for somebody who has credentials, which can mean a variety of things, but it's not that they have the credential that makes them necessarily any more smarter than the other guy, but the fact that they were willing to invest the time and effort and energy into being serious about what they're doing for a living. The effort more than the credential is important. Like, somebody who's taking the time to go above and beyond is an indication of somebody who is legitimately trying to do more for the client. I think that's a big one. Trying to figure out whether the person sitting in the chair, how much control they have over what it is they're offering to you. Like, are they sitting, is the name on their card the same as the name on the investment, which is the same as the name on the building? How long have they been there in that particular seat? How long have they been in the industry? These are all indicators for sure. And also, if you sit down and somebody starts by telling you what the best thing is to put in your TFSA, that's a bad advisor. Good advisor is going to start by asking you questions before they start getting to solutions. So sometimes it's, if they start making recommendations before you've asked any questions, that might be a red flag. There are a couple comedians now that do the whole red flag thing. So maybe we should do an episode on red flags from your advisor. Maybe that'll be the next pod.
Yeah. I think what you're saying there is you want to try to identify somebody that has a very good understanding of your goals, your objectives, your risk tolerance, things like this, the things that really matter to you, things that are meaningful to you. And if the person, any professional, doesn't matter whether it's a financial advisor or anybody else, if the person sitting across the table from you is not asking the types of questions to try to unearth the answers to those questions, then it's probably not going to be a fruitful relationship. The other thing, what you kind of alluded to there, is like, do they have to sell a proprietary product, or do they have the free range to do whatever they want from an investment perspective, being the full range of choices that should be available to them? So I think for me, just a bit broader, I think it's helpful to understand the business model and the compensation structure for the person that's across the table from you. So, who owns your business? This is a good question.
Yeah.
How do you get paid? How do I pay you? But not only how do I pay you or your organization, but how do you get paid? Like, what goes into determining your compensation? And people should be willing and able to give you clear, concise, and direct answers to these questions.
And also how the firm makes money. Right? So, there's two sides to it. Like, you're making money and that's fine, but the company you work for, how are they making money? What's their take on things? And, you gotta, you, to me, and I say this all the time, and you say it as well, what's the business model? That's a very broad question that encompasses all these things. It's not
Yeah.
just how the advisor's getting paid. How is everybody in the food chain getting paid? And therefore, how people get paid is going to be what their motivations are. And I've said this many times, there's fantastic people that are doing great work in spite of their environment. So just because somebody's in a compromised environment doesn't make them a bad advisor necessarily. But you want to look for somebody who doesn't have negative inducements in place.
Right.
In an ideal world.
Right. Yeah. This question should not be so much, how do you find a good or bad advisor? It should be more so, how do you find somebody who's going to provide good advice?
Yep.
So I don't really want to label somebody as bad necessarily. It could just be that, as you're saying, the incentives are set up in such a way that the outcome's probably not going to be in your best interest as a client.
But also be aware there are bad people out there too. I mean, we don't want to, say that there's no bad people out there. We don't want to draw that conclusion.
We don't want to let them off the hook. No.
No, because there are bad people for sure.
Yeah.
So.
Yeah, and for the record, you should ask this. If you don't understand this from your Verecan advisors or professionals, you should ask us as well. Those should be questions that you feel comfortable asking us when you're in the office with us or on the phone with us.
Yeah, and there's an old expression, I'm going to butcher it because I haven't looked it up lately, but I've never seen opacity or lack of clarity work in the favor of the customer. If something is opaque and difficult to understand, that's a sign that things are not lined up in the favor of the client.
So this is a good one. And also maybe not as old as time, but as old as taxes. And it's this aversion to wanting to make more money, aversion to making more money because you'll pay more taxes. So if I make more money, I'll have to pay more taxes. Why would I want to do that?
I wish Dan was here because this is the most animated I ever see Dan is when he's answering this question because it just frustrates him to no end. In the Canadian tax system, if you make $1, you're going to get to keep part of it. There is virtually no, there probably is a tiny exception that Matt's going to find one day because that's what Matt does. But there are virtually no situations where you can earn $1 and end up having to pay more than $1 in tax. So for every hour you work, every dollar you earn, you will get to keep part of it. It is true. The more you make, the least you get to keep. But congratulations, you live in Canada. So if you are already on pension and you are working part-time, or if you are working overtime, you're right. You're going to seemingly lose a bigger percentage of it. That doesn't make it worthless. You still get to spend that extra money. So you are always going to be better off, and except for the one time that's going to figure out the math, 99.99999% of the time by making an extra dollar. Because there's no scenario where you're going to lose more than $1 in tax. So that is something said by lazy people who are trying to justify a reason not to work, in my experience.
Or people that might not have a full understanding of the graduated tax system that we have in place. So
and lazy people.
And lazy people too. It is true that tax rates go up as you earn more income, but those tax rates go up on only the marginal or incremental income that you earn, not from $1. So you can make a new dollar and it could be taxed at 40%, where your past dollar was taxed at 30%, but you're still putting 60% of what you make in your pocket. Colin, if I have a pension and I'm going to retire with a nice pension, could be a teacher's pension, could be a municipal or government pension, why would I need any other savings?
Well, there's no reason that you do, but what savings do is money is options, right? So if you want options, then you should have savings because, we've gone through it enough in Canada with, Nortel, BlackBerry, there's different regional pensions that have struggled and not paid out their promised amounts. So anything short of a federal provincial government pension could have issues, not to say that they would or it's likely, but, could. So to think that it's, divine, it comes from heaven and can never ever be impacted, it's a bit of a stretch. But additional savings give you options, and options are powerful. And as you're in retirement and you don't necessarily have the capacity to earn more money, and you're stricken with the health situation, or there's a tariff situation that affects your world, or inflation, or something affects your cash flow, If you have no money, you have no options. If you have money, you have options. And, so you can, buy yourself some more freedom. But some of this comes down to the, living at the very edge of your financial means. There are those, and again, people who are wanting to spend everything on lifestyle. I got my pension, so I'm just going to spend the rest of my money. And, that's smart. That's a bit of an exaggeration. Maybe we call it smart. I want to live my life. I bet you do. But you also don't want to be, 70 years old and, trying to find a place to live that costs you less because you can't afford the place you're living in because you were living too close to the edge and you got pushed over it. So, when you're young and have the ability, try to take a look around at somebody who's 75 years old and is really struggling to make ends meet. That's not a comfortable place to be. And you can avoid potentially being that person by having a little bit more of a shock absorber to come and go on. So my answer to the question is nobody needs to save money. You just need to adjust your expectations as to what size box you're going to be living in underneath the freeway.
The biggest issue with the so-called pensions, I think, is the inflexibility that they offer. So if you're living within your means, under the amount that your pension's paying you every month, that's awesome. If for whatever reason you're pushed even $2 above that monthly pension amount, guess what? You have no flexibility if you have no other savings. You're done. So
you have decisions to make. You no longer get the nice rice. You have to get the cheap bargain rice.
You can't supersize your fries anymore. So
however that manifests itself in somebody's given world, right? But the best way to understand all this is money is options. And options can be, very, very comfortable, especially when you've given up your ability to earn more money. But listen, to those who want to run the ragged edge, our economy is run by people who don't save. People overspending, buying too many cars, going out to eat too much. The rest of us should celebrate these people. I'm not here to admonish them. I'm going to cheer them on because that's what keeps the overall economy growing. So I'm in favor of people overspending. But if you want to not overspend, you can come talk to us. We'll help you out.
So here's a close follow-up to that question then, Colin. How much do I need to retire?
Yes, you need to retire, yeah. It's sort of the stupid questions, and this industry trots out answers like $1 million, $2 million, no, $5 million. Just shut up. There's no answer to that question. When do you want to retire, and how do you want to retire? Until you can answer those questions, I can't come close to giving you an option. I've watched people live very comfortably under $20,000 a year, and some of the happiest people I've ever met, the most content people I've ever met, and then other people, can't live on $400,000 a year, and they're miserable all the time. So there's no answer to that. That question gets trotted out and answered in an effort to shame people into saving more money. You don't have $2 million, you're not serious about retirement. Oh my God, I'm serious about retirement. Well, how close to $2 million? I'm not close. Well, you should save more. That's all bullshit. When do you want to retire? How long do you want to retire? And what do you want to spend in retirement? Now I can start doing some math and saying, okay, to meet those goals, this is kind of where you have to aim. But there's no answer to that question, Josh.
Yeah, no, it's well said, and I have nothing to add. So this one's changing gears a little bit. When do I need to make changes to my portfolio asset mix? And I'll simplify things a little bit here by saying the mix between stocks and bonds, which are the two most traditional asset classes that you would find within a portfolio.
We go back and forth. So I think there's probably a couple of different ways to slice this particular onion. I don't think there's a pat answer to that. I mean, typically the pattern is as you get closer to retirement and relying on your money, you begin to take risk off the table. Now, typically that means moving from more volatile equities into more stable fixed income or high interest savings accounts. That's a rule of thumb, but it doesn't always hold true. Part of the problem is that people think of retirement as a date. Retirement's a phase of life, which for some people that phase of life can be 30 years. So, but that's still long-term. So to say that my risk profile, because I'm now in retirement, therefore my income, my time horizon is short. No. That's not the way it works. Your time horizon can still be long. It's a very fungible thing, but it is true that you do want to have, but there's different ways to reduce risk. It's not just about your asset mix. It's about getting debt free. It's about, setting up your living situation as to what you want to retire into and making sure the roof is replaced on the house. You got a new furnace or, you've found that apartment you want to move into or whatever. So there's a whole bunch that goes into it. But generally, you want to reduce, as a rule of thumb, reduce risk as you get closer to retirement. But it's not a formulaic thing. You remember the target dated funds, Josh? I don't know if they're even still a thing.
Still all over the place, especially in the pension world. But I would suggest we alter your language a little bit, and instead of closer to retirement, closer to a goal that requires needs of your money. Because that could be a lot of things. You're right. The most often priority is retirement. But if your goal is to buy a house in 5 years and that's your sole goal at the moment, then as you get closer to that, then you need to, or should think about, consider changing your asset mix as well. Or if it's whatever, education for your kids, that's one where as you get closer to that age 18, then you're starting to adjust asset mix as well. So like for me, just to be intentionally vague about it, when you look at adjusting your asset mix, it's when your goals, your risk tolerance, or your time horizon has changed. One of those three things.
Yeah, that's an infinitely better answer. Because it is, we substitute retirement oftentimes for when you need your money, and there's better ways to describe when you need your money. So your investment approach should, take into account when the money is needed. Retirement is one example, and because it could be that I'm going to stop work this year, but I'm not going to need this money for 10.
Yeah.
So that
totally
that changes that as well. So an infinitely better answer. I'm going to give you an infinite credit right now. Like wow. That was not just a little bit better.
That's like
infinitely better
gold star in our world. So that's great.
Like
but I also think it's worth.
Up.
Thank you. All these accolades. I think is also worth mentioning when you don't consider asset mix changes, and like for me, changes in the world that are more temporary in nature are something where you shouldn't be changing your asset mix because of that. And I'll use the one that's most front and center in our world today, and that's tariffs that were imposed yesterday as we record this, and could be unimposed by today as we record this. Deposed, I don't know. Posed. So those are one things that, like, temporary changes in the world don't always necessitate, and most often do not necessitate, changes in your asset mix.
Well, let me try to give an infinitely better answer. Fear and greed are two reasons not to change your asset mix.
Right.
So if you have an emotional response to something, that's not a reason to change your asset mix. Your asset mix should be changed based on when money is needed. That's what should drive your asset mix and nothing else.
Okay. Well, I'm giving you a rainbow stamp for that one.
Rainbow stamp?
Yes.
Ooh, I get all the colors.
So staying on the retirement track, since we were on there, I don't need to call this retirement. It could be any goal. When should I prioritize saving versus paying off debt?
There's no easy answer to that. So peel back the onion. So one side of it is behavioral, right? So paying off debt is a symbolic thing. It can signify a change in maturity, if you will, in somebody's journey towards becoming a completely self-sufficient human being. That may happen in your 40s or 50s, but paying off the debt can be a symbolic thing that's important. Paying off debt can reduce risk because going into a time when you need your financial independence, and not having debt reduces risk. So there's a few behavioral finance things that you can also pay down your debt just to run it back up again. So I've watched that happen. Like, there are people say, as soon as I pay down my credit card, I'll start putting money in my RRSP. 10, 15 years later, we're still paying off that same credit card because mentally, as soon as it goes down to $5,000, well, that's close enough to pay it off. I might as well, put this new TV on my credit card. So it becomes you never get to the second thing, so you never save anything. So if you're that person, you should start saving at the same time as you're paying off your debt. Otherwise, you'll never get to the second thing.
Yeah.
So that's a strategy as well. But mathematically, if you're just going to do the math, it's just comparing the interest rate, considering taxation. How expensive is the debt, and what's the reasonable expected rate of return? What is the tax efficiency? How much does the tax efficiency add to the savings program? So that's a multi-layered answer. Is there a better way to say that, Josh? Like, is there an infinitely better way to say that?
No, not infinitely better. I think the summary is that first look at the interest rate if the interest rate is high or high-ish, it probably makes sense to pay off your debt before you start saving. If you have credit card debt, pay off your debt. You're not going to have a better rate of return on your investments than saving 20% on your credit card debt. If you got mortgage debt, you could probably squint and it would make sense both ways. And if you're really worried about it, do a little bit of both, call it a day, and feel good about yourself, because both these things are productive.
Well, yeah, that's just it. I mean, I think you can win this by not answering the question. And if you've got a $500 or $1,000 worth of discretionary money in your pocket, and you want to make your situation a better thing, bet on both horses. Take half of it and pay down your debt, half of it and put it in RSP. That way, it doesn't matter which way is better. You did at least half right.
Yeah. All right. What's the difference between a dividend-paying stock and a growth stock?
Depends. There are stocks that are both. Yeah, let's cross the streams. These are labels that get slapped on shit to sell it. Is that a?
I'm so glad you did that, because my answer was going to be it's what we've decided to call them. That's the only difference, really. I mean, I guess if you're trying to get into, most of the time, a growth stock is growing, but all stocks are growing. Growth stocks are growing higher at a higher rate than the average stock, and dividends stocks are paying dividends at a higher rate than the average stock. So that's about it.
And dividends aren't even dividends anymore, because they used to be paying out a percentage of profits, and now it's turned into a return on capital. And companies are borrowing money and paying it out as dividends. And again, these are things that get trotted out largely for marketing, because to convince somebody, hey, this is a growth stock. Oh my God, this one's going to grow. Shut up! Literally,
I hope so.
Exactly.
If not, what am I doing here?
But I think largely they get interpreted, put into two buckets. Growth tends to be a little more volatile with a higher expected rate of return over time. And dividend-paying stocks are more about generating a cash flow. I'll call it that.
Yeah.
It's not paying you back profits necessarily, but it's more about generating cash flow. But the honest thing is, if you want to grow your money, just have a diversified portfolio and watch it grow. If you want to take money out to spend it, well, take money out to spend it. Yeah. One mistake we do see people make all the time is they put something in a market exposed investment, whether it's a dividend paying stock or what have you, and they cash a little bit out every month to spend it. That's dumb, because you are now cashing out regardless of market fluctuations, and that is dramatically increasing your risk and turns your portfolio into tremendously path dependent. So you can manage those risks by having a shock absorber in the form of a high interest savings account, and be a little bit more judicious about pulling money out. But watching people cash out a market exposed investment every month, the news now does matter to you. Like if you see a 20% market correction, that matters to you, because you're now cashing out, locking in losses at that point. So yeah, I think that's worth saying at this juncture. Is there a better way of saying that, Josh?
No, I think that's fair. I think what you said there is maybe the most direct way to answer it. Again, is dividend-paying stocks are marketed in a way that is designed for cash flow, and growth stocks are marketed in a way that's designed for more growth. But the reality is that dividend-growing stocks, or dividend-paying stocks rather, can be a great way to grow your wealth over time. And growth stocks probably shouldn't be used as a source of cash flow. So I'm not going to say that. I'm not going to argue the other side, but all these labels are kind of stupid. And most of the time,
stocks can pay dividends. Some companies that are classified as growth stocks, they some pay regular dividends. Now they're typically lower, and sometimes they pay special dividends or begin paying dividends when they get to a certain stage. So, but these are largely distinctions without a difference. What you want is your money to grow, and you need money when you need it.
And neither of these things are to be confused with dividend growth stocks. That's FAQ for another day.
I'm not ready for that one.
Yeah. Okay. Last one here, Colin. Why are you asking me about my will?
Yeah, it's more than a fair question. And I had more than one client, when I get to that point, or prospects say, why are we talking about my will? Like, if we're going to put all this money together, I need to know how you're planning on distributing it, because there can be things that you do that set your accounts up better depending on your goals. So setting up successor holders, setting up beneficiaries, choosing where to put money, can all be affected based on what's in your will. But also, this is the desk you sit around when shit goes sideways. So I want to make sure there's nothing stupid in your will. So if you got your third cousin who lives in Australia as your executor and you haven't talked to them in 10 years, I'm going to tell you that's stupid and beg you to make a change, because if you die and I have to try to sort that out, that is going to cause me, and I know your heirs, it's going to cause them a problem. So I've seen enough people make enough, unnecessarily complicate things. So, we don't write wills. We're not lawyers, but I've seen a lot of things go sideways, and we can highlight with, hey, that's a problem. That's a U.S. resident, U.S. citizen, and they're going to have to post a bond to act as an executor, and that's a problem you should try to avoid. Maybe you should talk to a lawyer about that. And somebody goes, oh my God, my last lawyer didn't bring that up. No, because your last lawyer just wrote down what you told them and charged you for it because it was a transaction to them. And they don't care because they're not going to be the one that has to sort it out in 10 years' time. That's going to be this office. And I don't want to sort that out. So please change it. So some of it's functional from how we set up accounts, others selfishly trying to avoid real messes that we've seen in the past, and maybe counsel people to seek legal advice to make changes.
If we are providing comprehensive financial advice, which is what we try to do, this is part of your financial world, is your will and who's set up to act as executor, how that money is going to be distributed, who's going to act as power of attorney on that money if you're unable to act on it. So all of these things influence the decisions that we're making today. And the opposite is also true. The decisions that we're making today influence what's going to happen there at the end of your life through your will, or when you're incapacitated and acting, or somebody's acting as power of attorney. So all this stuff's intertwined, and that's why we ask about it. That's why we ask about your debts. That's why we ask you about your assets. That's why we ask you about your real estate and your business and your income, because all this stuff is intertwined. And coming back to the question that we had earlier, how do you identify a good financial professional? Somebody that pays attention to all this stuff.
Well, you need me in this call anymore. I mean, that's where I was going to take it. That was going to be my big finish. I was going to tie them all together. But no, this goes back to you as your advisor, or we should, as your advisors, understand your goals. And you have, maybe, listen, I want to make sure my grandkids, blah, blah. Okay. But we can also counsel you. It's like, well, that's a step too far. There's not a real way to accomplish that goal you're talking about, because that's going to get into problems with whatever, whether it's matrimonial property issues or, and again, we know enough to ask the question. It's sending you to legal advice to get solid answers on things. But your financial goals for your estate are still financial goals, and we can provide some, sounding boards, some feedback, and help you organize your affairs accordingly. So we can play a role there. So yes, good financial advisors are going to care about these things, and they're not going to talk to you about getting your TFSA open today because we noticed you didn't have one.
And that's it for today. And we love these questions that come through. So if there are more frequently asked questions out there, however you define them, send them our way. We'll do another one of these and run through them one by one, quickly, succinctly, to the point. Thanks, Colin.
Thanks, everybody.
If you're breaking a sweat trying to figure out what your financial advisor is talking about, you're not getting the service you need. You probably hate trying to get an answer from them, but you also think moving your accounts will be a headache, and it might be. But working with don'trocktheboatwealthplanning.com or .ru isn't exactly stress-free, is it? Call us. We will demystify the world for you.
For more information on the subject of today's podcast or any other financial topic, please visit us online at verecan.com. That's Verecan.com. There's plenty of information there, or you can reach out to someone on the team. Thanks for listening.
Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Barenaked Money is produced by Verecan Capital Management, Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority. Remember, at Verecan Capital Management, Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together.